Okay, so in this video, I would like to talk about perpetuity with growth. So sometimes this is known as the Gordon growth model, and I want to start by giving you a formula. So the way that this is introduced is the following. So you're in year zero, or now, if you like. You'd like to find the price of a particular company, and you want to do so by estimating in a year from now, what is the dividend payment that you're going to get in year one? And then assuming that this company maybe is going to grow over time, and therefore dividends are going to grow proportionally with a growth rate. So let's say, for example, it's going to be the dividend in year one, growing at a rate of G, and then it's going to be dividend one plus G to the power of 2, and this will continue forever. Right? And the question is, what's the price that you'd be willing to pay for this company if it's going to throw you these dividends again, and those dividends are going to grow? We could derive this formula similarly to what we did in the previous video, but I'm not going to go and deriving it. I will simply give you what the formula is. The formula says the price that you would like to pay here is equal to the dividend that you get in a year's time divided by R. This is starting to look a lot like the perpetuity, okay? But this is more valuable, okay? So because these payments are going to be growing, right? And because this is a bit more valuable, um, here I'm going to divide by something smaller. And by how much smaller I'm going to divide is going to be dependent on the growth rate. So I'm going to subtract minus G. So what's the intuition here? This is a small number. By subtracting away a smaller number, by small number I mean less than 1, right? We're going to make this bigger. Okay, so for example, if I go back to, let's say you have a company that's paying you 100 million in dividends, okay, and you want a 5% discount rate, and you believe that those dividends are going to grow at, let's say, 3%, then it looks a lot like a perpetuity, but effectively with an interest rate of 2%. Okay, so if you have something that's paying you 100 million and your effective interest rate is 2%, then you are willing to pay 1 trillion for this company. Okay, so that's effectively a way how we think about a perpetuity with growth. So those are the mechanics. Those are the simple formula. So what's the simple formula? The formula is that the price is equal to the coupon payment in the first year, or the dividend payment, divided by the R, which looks a lot like the perpetuity without growth, minus the growth. Okay, and that's the first one. Now, we have a problem in this mental math here. As R, or as G is greater than R, well, we get something nonsensical here. Okay, and in particular, we get a division by negative, so we can't really quite understand that. But it suffices to say that as G gets to as G approaches R, okay, from the left-hand side, so this thing becomes closer and closer to zero, or closer and closer to zero. This thing here explodes to infinity, okay? Therefore, the perpetuity with growth formula kind of breaks down. And I'd like to give you a little bit of an intuition as to why this happens. You don't need this for your CFA level 1 exam, but it's nice to start building up some intuitions. When do these formulas kind of fail? Well, they do fail because the implicit assumption in these calculations is that this R, this R interest is not just the interest that you demand, or your required cost of capital, right, or your required reward, but it's equivalently as the rates you can borrow at. So implicitly, this kind of calculation, net present value calculations, have the simplifications that the R there is rates you can borrow at, and therefore, when growth rates are higher than the required return, you effectively have an arbitrage opportunity. Effectively, you can borrow at R from a bank. Let's say you're borrowing from a bank at 5%, and you can invest somewhere where it's safe at 7%. Well, what will happen then, right? Well, it looks like you could make infinite money by just borrowing, keeping and borrowing more and more money from the bank and investing them, paying 5%, investing them at 7%, earning the spread, and doing that day in and day out. Of course, if we know a little bit of economics, and the CFA, of course, is a section in economics, you'd understand that if that was the case, then those interest rates effectively would go up. Okay, there'll be more competition. So every time you have a model where you get an answer that the price of this company should be infinity, then you know that the model is wrong and there are some assumptions that are failing there. Okay. Um, so that's how you can think about this idea of perpetuity with growth. And what I would like to do in the next video is realize a little bit further, focus about equities and talk about what drives this. What drives this? So in the next video, we'll break this down um, on two other variables, which is return on equity and payback ratio. I look forward to seeing you on the next video.